Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about the pension income tax credit. Now this is a tax credit that's available to all Canadians if you hit a certain age and have qualifying income, which we'll go through in this video. Now there's a federal tax credit and there's a provincial tax credit. So all of you, no matter where you live, will get the federal tax credit, and you'll also get a provincial or potentially get a provincial tax credit as well on top of the federal tax credit. One of the main feedback and comments I get from viewers on all of our videos, when I show the financial planning software that we use, everyone fights back or pushes back and says, Adam, how can the average tax rate be so low in retirement? And this is where it's important. I'm gonna do a future video on this, marginal versus average or effective tax rate. I always say leading up to retirement, you wanna look at marginal tax rate. In retirement, we try and look at your average tax rate. Like what's the average amount of tax, and trying to level that out. And a lot of people notice that at 65 in the software, the average tax rate drops substantially. And a lot of that, if not most or all of that, is due to this pension income tax credit. So let's start off with the definition. The pension income tax credit is a tax credit on the first $2,000 of qualified pensionable income once you hit age 65. Once you hit 65, you want to make sure you have some sort of pension income. Now, what type of income qualifies for this tax credit? Eligible pension income generally includes income from annuities, Canadian registered plans, so RRIFs and whatnot, foreign pension plans, and pension income transferred from a spouse. Eligible pension income does not include old age security, CPP or QPP, retiring allowances, death benefits, payments from a retirement compensation agreement, RCA, and many other, or any withdrawals from an RRSP. Now, this is why also, I've talked about on this channel, like at 65, even if you don't want to convert all of it, when you convert it to a RRIF, this is one of the few reasons. One, there's some other reasons as well, but this is one of the reasons you want to convert it to a RRIF by 65, is if you take $2,000 out of an RRSP, it does not qualify for this tax credit. If you take $2,000 out of a RRIF, or retirement income fund, which is just your RRSP converted into an income stream type fund, then it qualifies for the tax credit. So if you're 65 or older and you're drawing money from an RRSP, put a pause on that and start drawing it from a RRIF. Convert your RRSP to a RRIF. You don't have to convert all of it. So if you have $250,000 in an RRSP and you're only converting it to get this tax credit, you can just move $2,000 from your RRSP over to your RRIF and be done with it. Draw it out and you qualify for this pension income tax credit. A few things to keep in mind with this pension income tax credit. It is non-refundable. So you have to have other taxable income to use the credit to write your tax bill down to zero. So keep that in mind. If you're not sure on that, talk to your tax accountant and figure out, am I able to use this, or how am I able to use this? Can I take a bit more income and then offset any taxes from that income with this tax credit? And that might be an option for you. So take a look at that. You might be able to actually draw more income than you're currently taking. Again, if you're trying to qualify for GIS, which is a very small number of you, but if you are, be aware of that. But if you're not, and you're able to maybe bump up your income a little bit more, use the tax credit to write your tax bill back down to where it was, obviously that's a great strategy. Now, if you're 71 plus, hopefully you've taken advantage of this by default because you've converted your RRSP to a RRIF and you've started drawing that out. But do keep in mind that you cannot carry forward this credit. If you don't use it in a year, it's gone. So make sure when you hit 65 that you start using this pension income tax credit. So the tax credit you get is 15% of the $2,000. So it does save you, it reduces your tax bill by up to $300 on an annual basis. Now, if you're married, common law, whatever, you have a partner, that's $600. And that's just at the federal level. This is why you want to be taking advantage of this. It's a free $300. Now, again, for a lot of you, if you're past 65, it might just be restructuring how you take money out. Maybe you're taking it just out of your RRSP because you didn't know the difference. Now you know the difference. Convert to a RRIF, put some money or all your RRSP into a RRIF, and start drawing that down. Now, hopefully you're already doing that for the RRSP meltdown and tax strategy. But if you're not, if you don't believe in everything else I talk about on this channel, this is a freebie. Get $2,000 of pensionable income that qualifies for this tax credit, start using it and start saving $300 every single year in taxes. When I present financial plans to clients and we start breaking down the numbers and the tax rates and average tax rates and really the tax payable, and clients always say like, Adam, why is there this drop off at 65? Like my taxable income has stayed the same, or maybe it's even gone up a little bit, but my average tax rate and the tax bill has dropped. And it's always because of this tax credit. And this is why I always say, like, when you hit retirement, the amount of tax you pay, if you're an individual, you're going to notice a big difference because you go from, employment income to retirement income. And many sources, some of those sources are going to be maybe non-registered funds, or tax-free savings account. Tax-free savings account comes to you absolutely tax-free. Your non-registered investment or your taxable investment account, it's going to be a bit of tax ongoing, but a lot of that's just your money coming back to you. Once you hit 65, you also get this pension income tax credit. So there's ways that you're drawing income, and it's much more tax efficient. So you're going to notice when you hit retirement that you're paying a lot less tax than you've ever paid before, even with the same amount of income. So if you go into retirement and you were making $60,000 a year, and in retirement now you're making $60,000 a year, I promise you, you will pay less tax. On top of the federal pension income tax credit, there's also provincial tax credits for pensionable income. Now, it's in every province and territory except Quebec. So unfortunately, if you live in Quebec, there is no provincial tax credit, but you still qualify for the federal tax credit. So that's a bonus. Every other province or territory does have some sort of pension income tax credit. It varies per province and territory. We'll throw this up on the screen, but you'll see in BC where I'm at, the maximum pension tax credit is only $51. If you go to Ontario, which is where a lot of our viewers are from, a bit higher at $78. In Alberta, $149. For a married couple or common law partner couple in Alberta, you're saving $449 per individual. So $900 off your tax bill once it's 65. Like, that's a big drop because, again, you're already paying less tax in retirement, and now your tax bills drop by $900 a year. That's why people notice it when we present these financial plans. Again, we'll leave the link below on what qualifies for this tax credit, but you want to make sure you take a few steps from here. A, understand what qualifies. Then B, look at your financial world. Are there potential income sources that would qualify for the tax credit that you're not taking advantage of if you're over 65? If you're under 65 and watching this, you want to make sure that you're ready for this. Make sure that you build up your accounts to the point where at 65 you can convert some of your RRSP or you have your pension plan. Understand what the benefits are at 65 so that you don't miss out on this. So make sure that, if you're taking RRSP right now, convert it to a RRIF. If you haven't started some sort of pension plan, something that qualifies for this credit, turn that income on if you're 65. Again, this pension income tax credit, a lot of you are not taking advantage of it. You're sleeping on this. Maybe you're still working. Look, if you're still working past 65, you can still use this pension income tax credit. What you can do is you can take your RRSP, set up a RRIF at the, wherever financial institution you invest at, and roll just $2,000 from your RRSP to a RRIF and redeem it. Then you get $2,000 out of your RRSP, essentially, out of your retirement money, and that will still qualify. You can still be working, have employment income past 65, and still use this pension income tax credit. So even if you're working past 65 or you don't need the money, you want to make sure that you're drawing at least $2,000 of pensionable income to take advantage of this tax credit. So hopefully this clears up the pension income tax credit. Hopefully it gives you clarity what you need to do, what qualifies for the credit, and how much the credit is. All those three things are very important. Make sure you understand it. We'll put some links below to help you out through that. If you have any questions, put them in the comments below. Thank you for watching this video, and we'll see you in the next one.